What is small bay industrial? Have you ever heard the term small bay industrial properties, but really didn't understand what it means? It's one of the most overlooked, but highly performing assets in commercial real estate right now. If you're looking for durable tenants, cash flows, and limited competition, then small bay industrial might be the asset class that you're looking for. Big industrial warehouses get all the attention, but now investors are looking at smaller industrial assets as the asset class to invest in. In this video, I want to show you why small bay industrial is one of the hottest commercial real estate categories as of 2025. By the end of this video, you're going to understand what small bay industrial is, why it's in such high demand, why there's little competition, and how it fits into a stabilized, cash-flowing real estate portfolio. All right, so what's the definition of small bay industrial? Small bay industrial refers to multi-tenant industrial buildings with smaller individual units, typically under 10,000 square feet per bay or per unit. When I'm referring to small bay industrial, there's a lot of names for these types of properties. Some people call them small bay warehouse. Some are mini warehouse. Some are small contractor bays. Some are contractor flex space. So there's a lot of different names for this asset category. But small bay industrial is the most used term for this type of asset class. What we're talking about here is 1 to 5,000 square foot units typically, and they're smaller users that occupy warehouse space. And a true small bay industrial property has multiple tenants, anywhere between 5 and 50 tenants. You might see a business park where it's industrial users, but you'll see some retail users in there as well. That's the power of small bay industrial is there's multiple tenants occupying one property location. So what are the typical features of a small bay industrial unit? Well, there's drive-in roll-up doors. We like to have 12 to 14 foot high garage doors that tenants can drive in and out of. Clear heights with the ceilings, anywhere between 12 feet up to 20 plus feet. So there's multiple racking that you can place in the property. Minimal office build out, typically between 5 and 10% of the overall warehouse space. The construction's built with concrete tilt-up, CMU, which is concrete masonry unit block, or metal buildings. Shared parking and loading areas. Some have loading docks, some don't. Parking is essential because tenants need a place to put their fleet of trucks or their employees coming in and working at the space daily, as well as customers that are going to be coming doing business at the location. And multiple tenant layouts where 5 tenants all the way to 50 tenants at that one location. You could think of it like it's the commercial equivalent of a self-storage facility, but with a few more amenities where business owners or tenants can occupy the property to run their business out of and warehouse their materials or their supplies. So why is small bay industrial in such high demand right now? I've researched that there's around 900,000, maybe a million units of small bay industrial spaces throughout the country, and they operate at a 95% average occupancy rate. So there is a very high demand, and tenants need this type of space. Why? Well, first off, it's affordable. It's much cheaper than retail or office space. Secondly, it's very easy and flexible, demisable, meaning that there's no walls if you don't want them. It's a large warehouse space where if you want an office, you put an office, or the landlord can build an office and a bathroom. But it's flexible space to use. Next, there's a minimal supply based on how many users need it. And there's not been a lot of construction over the last 20 years in this category. Investors were more interested serving big box warehouses like Amazon or IKEA or any of the big industrial users that are credit tenants versus building for the small service home provider or the warehousing tenant that needs this type of space. The locations are beneficial. They're near transportation routes, typically highways, for the last mile fulfillment of supplies or warehousing materials needed. And they're sticky tenants. These tenants typically don't move over the life of their business. They'll just occupy another unit in the business park. They are serving local customers, so they're going to need to be located at your location as long as there's strong demographics for people that need services from these contractors. I've bought and built a handful of these contractor units or small bay industrial properties. I bought a property in North Franklin, Connecticut, right outside of UConn, the University of Connecticut, and did very well. The reason being there was 20 units. It was roughly 30,000 square feet, and there was an older owner that wasn't focusing on the property management. This asset checked all the boxes. Metal buildings, bought it at a great basis, under $60 a square foot, below replacement cost. The rents were half the market rents at $4 or $5 or $6 a foot. The market rents were above $10 a foot. And all it took was some advertising, marketing, and good property management to first make sure that the tenants start paying. Secondly, we evict the tenants that aren't paying. And then thirdly, backfilling the units that are vacant with good quality tenants that want to pay market rents. And we made minor improvements, improved the signage, improved the lighting, cleaned up a lot of debris in the property, improved the landscaping, and then created strong advertising that allowed us to attract more quality tenants that like the location. Click a link in the comments below, and there's a case study about this property. And if you're looking to invest in small bay industrial, it's a great primer or a great playbook of what a great deal looks like and also how to execute on the business plan. And the result of that was increasing appreciation over 4 years, $2 million. That was phenomenal. And then refinancing the asset and pulling out close to $1.2 million of investor capital. In that case study, it outlines that we appreciated the property $2 million over 4 years of ownership from 2021 to 2025. And the great thing is we didn't even sell it. We were able to refinance it and pull out $1.2 million of additional proceeds or debt, paying off of our initial debt and having that cash, and then paying back investors their $600,000 investment and still having an additional $600,000 of proceeds that we can distribute as additional profits to investors. And we still have the property and it still cash flows. One of my favorite deals that I've done, and it's an interesting case study in the power of why small bay industrial can be so lucrative as a real estate investor. So how does small bay compare to other industrial asset classes? Well, you have big box industrial. These are large warehouses, 100,000 square feet to millions of square feet. These are logistics and fulfillment, the Amazons of the world. And the investor focus is institutional investors. The pros are they have a quality tenant that is a Fortune 100 tenant with very high credit rating and the ability to pay the rent. The risk is the vacancy. If that tenant leaves, there can be time that it takes to fill that space. And that will eliminate cash flow, but yet the operating expenses are still due on the property. Now, there's some core markets where industrial does very well, but it's a big boy game that takes lots of dollars, and these properties trade for tens of millions, if not hundreds of millions of dollars. Next is mid-bay industrial or mid-bay flex. This is between 10,000 and 50,000 square foot users, anywhere between 50 and 150,000 square feet. So what I mean is this is a step up from small bay. Mid-bay is light manufacturing, larger warehousing. These tenants want longer-term leases. They're more established businesses. You're not typically getting home service providers or contractors out of this space. And there's a mix of investors that like this asset class. You get regional players and you get some institutions and some private funds that want long-term leases and stable tenants. But still, you have the risk of the vacancy where if one larger tenant moves out, that can diminish a lot of your cash flow. And there can be a lot of tenant improvements needed and leasing commissions to be able to backfill the units where tenants leave. And then you have small bay industrial, where you have the tradesmen, you have the contractors, you have storage guys, where just mom and pop guys that like to have a man cave and want to store their stuff in there and get away from the wife at the house. These are all poor quality tenants when you look at their credit rating, but high quality tenants when it comes to the stickiness that it's a small amount of rent. And if they do have a decent balance sheet and some money in the bank and an existing business that's been around for a few years, they typically stay. So on an institutional level, they don't check out. But on a private investor level, in my eyes, as long as you're underwriting the tenant, they're great tenants to have. And you have that diversified stream of income where the tenant's leases are staggered, meaning that they can be a 1-year lease, 2-year, 3-year, or up to 5-year lease, depending on the type of tenant you have in there, protecting the downside of any one tenant leaving, eliminating all that cash flow. Another pro is that there's not a lot of tenant improvements needed. These tenants understand that they may want an office, they may want a bathroom, or they may just want cheap rent and they'll build it out themselves. So the tenant improvements are much less than other types of commercial real estate assets. Also, they keep up with inflation well, so the rents increase year over year. That is normal for these types of tenants, and they are open to short-term and long-term leases. This provides investors a lot of flexibility on managing inflation, being able to raise rents and condensing lease periods, because you may be entering into a long-term inflationary market where we don't want the long-term leases because we're fixed at a 3% or 2% increase or no percentage increase on that lease, like in some of the larger real estate tenants that the mid-box or the large box operators have or tenants have. With small bay, there's short-term leases that you can increase the rents and in turn outpace inflation. The cons are they can be heavily management intensive, where tenants do not pay, you have to evict. There could be parked cars. There could be people doing improper uses in the property, like working on cars or painting cars, and you don't have the zoning for that. That means there's going to be a lot more management and there's going to be a lot more oversight of these types of tenants and hands-on interactions with them to ensure they follow the rules, pay the rent, and not damage the property in any way or pollute the property with any toxicity. The beautiful thing is small bay cap rates are going down. Investors are seeing this and they're trading at lower cap rates where they used to be in the 8-9 cap rate range, and now we've seen them in the 5 or 6 or 7 cap rate range, depending on the core market and the quality of the rent roll that investors are buying into. Yet, it's still a very fractionalized industry. A lot of mom and pops own these business parks. They are sometimes tenants within the business park or the small bay warehouse park, and they are ready to sell, and they don't really care about managing or wanting to put a lot more energy or capital back into the property, upgrading it to current tenant standards. So who's investing in small bay industrial? Now we're seeing a lot of new people in the space. There's the local and regional investors that have been investing in these for the last 40 years. There's private equity firms now that love the space. Like my firm, Patriot Holdings, we focus on buying small bay value-add warehouse, and we've seen a lot of other funds enter the space. Large institutions are now entering the space where they want to buy portfolios, millions of square feet of multiple small bay properties or business parks that they're bringing into their funds. Do I recommend building small bay rather than buying it? Yes and no. Constructing small bay properties are lucrative, yet it takes a lot of expertise in management. Remember, you're starting from scratch. You're having to get the engineering done. You have to buy the land. You have to get the right zoning, and you have to execute on time and on budget with a good contractor or project manager. And then you have to fill up the property with new tenants. I did a project in New Hampshire where I built one ground up, and it's been successful, yet it's been a challenge. So click on the comments below and I can show you a case study of that project below. Yet I would suggest starting out, not getting into ground up development. Because remember, you're also needing to do tenant improvements and offer leasing commissions to leasing agents to fill up that property. So there's a lot of additional capital you're going to need. You're going to need your reserves to make sure you can pay the interest to the loan while you're filling it up, plus those tenant improvements, plus the leasing commissions, and all the time and energy to build that property. So the juice has to be worth the squeeze. I would suggest it would have to be at least a 3x multiple or 30% IRR, and that would justify doing a ground up project. But if you're inexperienced, I suggest pausing on that and buying an existing one and learning the game first before you jump into development into small bay. So the real benefit of small bay for me is protecting the downside, is we are serving HVA contractors, pavers, plumbers, siding guys, all these home service providers that need space to work out of, plus additional warehouse tenants that need to put their supplies or put in materials in these locations to serve their regional customers. And if you haven't seen, over the last 5 years, there has been an influx of private equity in the home services space. A friend of mine sold his garage door company in the Southwest US for $1 billion to install garage doors. And that is happening all across the industry. So there is an influx of capital in that area. And there's a lot of these home service guys that need real estate to operate out of. And they're going to be looking for more and more of this space. And these are recession-resistant industries where people still need to get their AC fixed in the middle of summer, their heat installed in the middle of winter, and everything else that needs to be done to their home in order to live their lives. So it's a recession-resistant business because they occupy small bay. And also, small bay is the cheapest rent compared to retail and office. It gives you the most amount of flexibility for the type of businesses that are operating today. Where some businesses need office, need retail, and need warehouse, and it fits all of those boxes. So I love it by protecting the downside, and it's about meeting the needs of what businesses need for the future. So this is the asset class that I'm going to focus heavily on, and I highly suggest you do too. So if you have questions, reach out to us at Patriot Holdings. Click the link below, and we can go over exactly what your real estate investment strategy is. And if small bay fits in that, we're happy to share our opportunities with you and explore our Patriot funds. Thanks for coming by.